We've been taught that all debt is bad, that borrowing money is something you do when you failed at managing your finances, that the responsible thing, the smart thing, is to never owe anyone anything. And I get it. That advice makes sense when you're talking about credit cards or payday loans or buying things you can't afford just because you want them. Those kinds of debt will absolutely destroy your financial life. But here's what nobody tells you. There's a kind of debt that actually makes you richer, not just in theory mathematically, provably richer. And most people avoid it their entire lives because they've been conditioned to believe that all debt is the enemy. Let me walk you through this, because understanding the difference between debt that destroys wealth and debt that creates wealth might be the most important financial concept you ever learn. First, let's talk about what makes debt bad, because not all debt is created equal, and if you don't understand the distinction, you'll either avoid all debt and miss opportunities, or you'll take on the wrong kind and drown. Bad debt has a few defining characteristics. It's debt used to buy things that go down in value. It's debt with high interest rates that compound against you. It's debt that doesn't generate any income or future value to offset the cost of borrowing. Credit card debt is the classic example. You borrow money at 20% interest to buy things that either disappear: food, entertainment, clothes, or lose value the moment you buy them. That 20% interest compounds monthly, working against you, making you poorer with every payment you miss. Car loans for depreciating vehicles fall into this category too. You borrow $30,000 to buy a truck that loses 20% of its value the moment you drive it off the lot. You're paying interest on an asset that's actively losing value. You're moving backwards financially, even as you make your payments. Payday loans, rent-to-own furniture, high-interest personal loans for vacations or weddings, these are all bad debt. They cost you money, they don't generate any return, and they trap you in a cycle where you're constantly paying for the past instead of building for the future. This is the debt people warn you about, and they're right to warn you. This kind of debt is financial poison. But here's where it gets interesting. There's another category of debt that works completely differently. It's called good debt, or productive debt, or leverage. And it has the opposite characteristics of bad debt. Good debt is used to buy assets that go up in value or generate income. Good debt comes with lower interest rates because it's backed by collateral. Good debt creates more wealth than it costs to service. Good debt is a tool that wealthy people use to get wealthier. The most common example is a mortgage. When you take out a mortgage to buy a house, you're borrowing money at a relatively low interest rate, let's say 6 or 7%, to buy an asset that historically appreciates at 3 to 4% per year and provides you with a place to live. But it's more than that. Without the mortgage, you'd be paying rent, which is money that disappears every month with zero return. With a mortgage, every payment builds equity. You're essentially paying yourself, or more accurately, you're paying your future self. Let's look at the math. Say you're paying $2,000 a month in rent. Over 30 years, that's $720,000 you paid to someone else. At the end of those 30 years, you have nothing to show for it. Zero equity, zero ownership, zero return. Now say you buy a house with a mortgage. Your payment might be the same $2,000 a month. Over 30 years, you pay the same $720,000. But at the end of those 30 years, you own the house outright, and if that house appreciated at even a modest rate, it might be worth $600,000 or more. So in scenario 1, you paid $720,000 and have nothing. In scenario 2, you paid the same amount and have a $600,000 asset. The difference is enormous. And the only reason scenario 2 works is because you took on debt. Now, I can hear the objection already. But you didn't mention the interest. The mortgage has interest. You actually pay way more than $720,000 over 30 years. And you're right. With interest, you might pay closer to $1.2 million over the life of a 30-year mortgage. But here's what people miss. You're not comparing the mortgage to nothing. You're comparing it to rent. Rent also has an implied interest rate. It's essentially a 100% interest rate because you pay and receive zero equity in return. You're paying someone else's mortgage plus their profit margin. When you look at it that way, the 6 or 7% mortgage interest suddenly looks pretty reasonable. But mortgages are just the beginning. There's an even more powerful form of good debt that most people never consider because they've been taught that debt is bad, and that's debt used to invest in income-generating assets. Think about how businesses work. Almost every successful business was started with some form of debt. The entrepreneur borrows money either from a bank, from investors, or on credit cards early on and uses that money to build something that generates more money than the debt costs. If you borrow $50,000 at 8% interest to start a business, your annual interest cost is about $4,000. But if that business generates $10,000 in profit per year, you're making $6,000 more than the debt costs. That debt made you richer. Real estate investors use this principle all the time. They borrow money to buy rental properties. Let's say you buy a rental property for $200,000. You put down $40,000 and borrow $160,000 at 5% interest. Your mortgage payment might be about $850 per month. But if you can rent that property for $1,400 per month, you're making $550 a month in profit even after paying the debt. That's $6,600 a year in passive income generated by using debt. And here's the beautiful part: the tenant is paying down your mortgage for you. Every month, part of your mortgage payment goes toward principal, increasing your equity. The tenant is building your wealth while you collect the profit on top. That's leverage. That's good debt working for you. Now, I want to be really clear about something. Good debt only stays good if you're using it correctly. You can turn good debt into bad debt very easily if you're not careful. A mortgage for a house you can't afford is bad debt, even though mortgages are generally good. If you borrow so much that your payment eats up 50% of your income and you can't save anything, that's bad debt. You've taken a tool that should build wealth and used it to trap yourself. A business loan for a business that doesn't generate profit is bad debt. A rental property that stays vacant or needs constant repairs that eat up all your income is bad debt. The category of debt matters less than what you do with it. So what makes debt good? It comes down to a few key factors. First, the debt must be used to acquire something that either increases in value or generates income. Ideally, both. If you're borrowing money to buy something that just sits there losing value, it's bad debt. Second, the return must be higher than the cost. If you're paying 5% interest on a loan, the asset you bought with that loan needs to generate or appreciate by more than 5% per year. Otherwise, you're losing money on the deal. Third, you need to be able to afford the payments comfortably. Even good debt can destroy you if you overextend. If your debt payments prevent you from saving, from building an emergency fund, from having any financial breathing room, it's too much, regardless of whether it's technically good debt. Fourth, you need a backup plan. What happens if the rental property sits vacant? What happens if the business has a slow year? What happens if the housing market crashes? Good debt requires risk management. You need reserves, you need insurance, you need to be prepared for things to go wrong. Here's where most people get stuck. They understand the concept of good debt intellectually, but they're too afraid to use it. They've been so conditioned to avoid debt that they can't pull the trigger even when the math makes sense. So they save to buy a rental property in cash, which takes them 15 years. By the time they have the cash, they've missed 15 years of appreciation in rental income. If they had borrowed and bought the property earlier, even accounting for the interest, they'd be much wealthier. Or they refuse to get a mortgage because they want to be debt-free. So they rent for decades while saving up to buy a house in cash. By the time they can afford it, housing prices have doubled, and they paid hundreds of thousands in rent that built someone else's wealth instead of their own. This is the trap of avoiding all debt. You avoid the risk, but you also avoid the opportunity. And in many cases, avoiding the opportunity is the bigger risk. Let me give you a concrete example of how this plays out over a lifetime. Person A is debt-averse, they rent, they save diligently, and they eventually buy a house in cash at age 55. They live debt-free and feel good about it. Person B takes on good debt. They buy a house with a mortgage at age 30. They take on some risk, but they build equity for 25 years while person A is paying rent. By age 55, person B owns their house outright. Same result, but person B got there by using debt strategically. Except it's not the same result, because during those 25 years, person B's house appreciated in value. If they bought for $300,000 at age 30, it might be worth $600,000 by age 55. That's $300,000 in appreciation they captured. Person A, meanwhile, paid rent for 25 years. If they paid $1,500 a month in rent, that's $450,000 they paid to landlords, money that's gone forever. So person B is $300,000 richer from appreciation, and they didn't lose $450,000 to rent. That's a $750,000 swing, all because person B was willing to take on good debt and person A wasn't. Now, let's talk about the psychology of this, because the numbers are one thing, but the emotional resistance to debt is something else entirely. We've been conditioned to feel shame about debt, to see it as failure, to believe that if we were just more disciplined or made better choices, we wouldn't need to borrow money. And again, that's true for bad debt. You should feel uncomfortable about credit card debt or car loans for luxury vehicles you can't afford. That's appropriate discomfort. That's your conscience telling you you're making a mistake. But good debt is different. Good debt is a tool. It's not shameful to use a tool to accomplish something you couldn't accomplish without it. It's not a failure to borrow money to buy a house or start a business or invest in an opportunity that will make you money. The wealthy understand this instinctively. They don't avoid debt, they avoid bad debt. They use good debt aggressively because they understand that leverage is how you accelerate wealth building. If you have $100,000 and you want to buy rental properties, you could buy one property for $100,000 in cash. Or you could put 20% down on 5 properties, borrow the rest, and own 5 properties instead of one. Yes, you have debt. Yes, you have risk. But you also have 5 times the rental income, 5 times the appreciation, 5 times the wealth building. As long as the math works on each property, more debt equals more wealth in this scenario. This is why you'll sometimes hear wealthy people say they want to be in debt. It sounds crazy if you don't understand leverage. But what they mean is they want to be in good debt that's generating returns higher than the cost of the debt. Now, here's the critical question. How do you know if a specific debt is good or bad for you? You need to run the numbers, not in your head, not with rough estimates. You need to actually calculate it. If you're considering a mortgage, calculate your total cost over the life of the loan, including interest. Then compare that to what you'd pay in rent over the same period, factoring in rent increases, and consider the equity you're building and the appreciation you're likely to capture. If you're considering a business loan, calculate the interest cost per year. Then honestly assess how much profit the business is likely to generate. If the profit is significantly higher than the interest cost, and you have reserves to handle slow periods, it might be good debt. If you're considering an investment property, calculate the mortgage payment, property taxes, insurance, maintenance, and vacancy rates. Then calculate the expected rental income. If the income exceeds the expenses by a comfortable margin, it's probably good debt. But if the numbers are tight, if you're relying on everything going perfectly, if you have no margin for error, it's probably not worth the risk, even if it's technically in the good debt category. Here's another way to think about it. Good debt amplifies your earning power. Bad debt amplifies your expenses. When you take out a mortgage, you're amplifying your ability to own an appreciating asset that you couldn't otherwise afford. When you take out a business loan, you're amplifying your ability to generate income. When you take out an investment property loan, you're amplifying your portfolio and your passive income streams. But when you take out a credit card to buy furniture, you're just amplifying your expenses. You're not creating anything. You're not building anything. You're just spending tomorrow's money today and paying interest for the privilege. So the question isn't, should I avoid all debt? The question is, does this debt amplify my earning power or my expenses? Let me address one more common objection. Some people say, I don't want to be tied down by debt. I want freedom. And I respect that. Financial freedom is important. But here's the paradox: good debt can actually create more freedom, not less. If you refuse to take on a mortgage and insist on renting until you can buy in cash, you're tied to your rental situation for decades. You can't build equity. You can't benefit from appreciation. You're at the mercy of your landlord and rising rent prices. Is that freedom? If you take on a mortgage strategically, within 15 or 20 years, you own an asset. You have equity. You have options. You can sell, you can downsize, you can rent it out. The debt that initially felt constraining actually created freedom down the road. Same with business debt. Yes, having a loan payment is a responsibility. But if that loan helped you build a business that generates income and grows in value, you've created freedom. You have an asset. You have income streams. You have options you didn't have before. Debt doesn't equal constraint if it's used to build assets. Debt equals constraint when it's used to fund consumption. So, where does this leave you? What should you actually do with this information? First, audit your current debt. Separate the good from the bad. If you have credit card debt, car loans for depreciating vehicles, personal loans for consumption, that's bad debt. Pay it off as fast as possible. That's not a tool. That's a trap. But if you have a mortgage on a house that's appreciating, or a loan on a rental property that's generating income, or a business loan that's funding a profitable venture, that's good debt. Don't rush to pay it off if the return exceeds the cost. Let it work for you. Second, get comfortable with the idea of strategic debt. Not all debt, not reckless debt, but calculated, well-researched debt that amplifies your ability to build wealth. If you've been avoiding buying a house because you don't want a mortgage, run the numbers. Compare the total cost of a mortgage to the total cost of renting, plus the opportunity cost of not building equity. You might find the mortgage is actually the less expensive option long term. If you've been thinking about starting a business but you're afraid to borrow the startup capital, calculate the interest cost versus the potential profit. If the profit significantly exceeds the cost and you have a plan to manage the risk, it might be the smartest financial move you ever make. Third, learn to evaluate opportunities through the lens of return on investment. Not just can I afford the payment, but what is this going to generate relative to what it costs? A $1,500 monthly mortgage payment might seem expensive, but if it's building equity in a house that's appreciating and saving you from paying $1,500 in rent, it's actually not expensive at all. It's an investment. A $10,000 loan to buy equipment for a side business might seem scary, but if that equipment allows you to generate $3,000 a month in additional income, it pays for itself in 4 months. After that, it's pure profit. That's not scary, that's smart. Fourth, build your financial foundation first. Good debt requires a buffer. You need an emergency fund. You need insurance. You need reserves. If you're living paycheck to paycheck, you're not ready for good debt yet because you have no margin for error. But once you have that foundation, once you have some stability, strategic debt becomes a tool you can use to accelerate your wealth building beyond what you could achieve just by saving. Here's the truth that nobody wants to say out loud. The wealthy use debt to get wealthier. They understand leverage. They understand that you can achieve in 5 years with strategic debt what might take you 20 years without it. The poor avoid all debt, including good debt, because they've been burned by bad debt or they've been taught that all borrowing is shameful. And they stay poor because they never access the tools that could help them build wealth. The middle class takes on mostly bad debt car loans, credit cards, consumption, and stays trapped on the hamster wheel, working to pay off debt that's not building anything. You have to decide which category you want to be in. And if you want to build wealth, if you want to create financial freedom, you have to learn the difference between debt that destroys and debt that creates. Good debt exists. It's real. It's powerful, and it's one of the few tools available to people without family wealth to actually build significant net worth in their lifetime. Use it wisely. Use it carefully. But don't be afraid to use it, because avoiding all debt might feel safe, but it's often the most expensive decision you can make.